Hey there, welcome to Go Lofty Academy, your express MBA for founders, strategists, and ambitious doers ready to build smarter. I'm Leah, your virtual co-strategist in the journey of building, funding, and scaling your startup. Today's topic is the backbone of every successful startup business model, unit economics. In this video, we'll unpack what unit economics really means, key metrics, CAC, LTV, churn, ARPU, payback period, how to calculate them, SaaS startup benchmarks for launch and growth stages, a practical breakdown of unit economics for an AI agent product. Stay with us to the end and I'll give you a full checklist and tip sheet to keep your numbers investor ready. And don't forget to subscribe and check out our curated playlists for startup growth, investor decks, and more. Let's start with the basics. Unit economics is the revenue and cost tied to a single unit of your product. In SaaS, that usually means one customer. Ask yourself, are we making more money from each customer than it costs us to acquire and serve them? How much you spend to get a new customer. Customer acquisition cost, CAC, is the total cost a business incurs to acquire a new customer. It includes all marketing and sales expenses, such as advertising, salaries of sales and marketing staff, software tools, and any related overhead, divided by the number of new customers acquired in a given time period. Why CAC is important to investors. Profitability indicator, CAC directly impacts unit economics. If it costs more to acquire a customer than the revenue that customer generates, the business model is unsustainable. Scalability. Insight. Investors assess if a company can grow efficiently. A low or declining CAC suggests that customer acquisition can scale without proportionally increasing costs. LTV-CAC ratio. Analysis. CAC is used alongside lifetime value, LTV, to evaluate whether a business earns significantly more from a customer than it spends to acquire them. A healthy LTV-CAC ratio is typically 3.1 or higher. Cash burn management. High CAC often leads to faster cash burn. Investors want to ensure that the startup can manage runway and doesn't rely endlessly on funding rounds. Market fit validation. A falling CAC over time often signals improved product market fit, stronger brand awareness, and more effective marketing strategies. How much revenue you make per customer before they leave. LTV, customer lifetime value, refers to the total revenue a business expects to earn from a customer over the entire duration of their relationship with the company after accounting for churn. It's typically used in SaaS and subscription-based models, but applies broadly across sectors. Why LTV matters to investors. Signals. Business sustainability. A high LTV indicates that customers generate strong long-term revenue, meaning the business model is more likely to be self-sustaining and scalable. Informed CAC payback. Investors often compare LTV to CAC, customer acquisition cost. A healthy ratio, typically 3.1, shows that the company earns much more from a customer than it spends acquiring them. Forecasts revenue potential. LTV helps estimate future cash flows, a key input in valuation models like DCF, discounted cash flow, which investors use to assess startup worth. Guides, product market. Fit assessment. High and increasing LTV suggests the product meets a real need and retains customers. A green flag for investors betting on long-term growth. Improves strategic decision-making. Investors want to see that LTV is being used to optimize marketing spend, customer segmentation, pricing, and retention strategies. ARPU, average revenue per user, measures the average amount of revenue a company generates from each active user or customer over a specific period, usually monthly or annually. Why ARPU matters to investors. Revenue efficiency. Indicator. ARPU shows how much value you're extracting from each customer. Higher ARPU often indicates effective pricing and strong product market fit. Benchmark for growth potential. When ARPU is increasing over time, it can signal upselling, cross-selling, or pricing power. All attractive signs for investors. Segmentation and strategy. Insight. Investors use ARPU by segment, e.g., SMB versus enterprise, to understand where the most valuable users come from, helping validate go-to-market strategy. Influences valuation, multiples. A company with high ARPU is often seen as more monetizable and capital efficient, supporting higher valuation multiples. Feeds into key metrics. ARPU is a critical input in LTV, payback period, and cohort analysis, which investors use to evaluate customer quality and unit economics health. Churn rate is the percentage of customers, or revenue, that a business loses over a given period. It reflects customer dissatisfaction, product fit, or pricing issues, and is one of the most critical metrics for SaaS and subscription-based models. Why churn rate matters to investors. Direct indicator of retention and product value. High churn means customers don't see enough value to stay. That's a red flag. Low churn suggests stickiness and strong product market fit. Impacts lifetime value, LTV. Since LTV is inversely related to churn, reducing churn is one of the fastest ways to boost long-term customer profitability. A key investor focus. Affects growth efficiency. If a company is spending heavily on CAC but losing customers quickly, it's burning capital inefficiently. Investors will spot this fast. Predicts revenue stability. Investors love predictable revenue. A low churn rate gives confidence in recurring income streams and helps in accurate financial forecasting, reveals operational and strategic issues. A rising churn rate might highlight problems with onboarding, support, product quality, pricing, or competition, critical factors in due diligence. Gross margin is the percentage of revenue that remains after subtracting the cost of goods sold, COGS. In SaaS, COGS typically includes hosting, support, and software infrastructure, not sales and marketing. Why gross margin matters to investors. Indicates scalability. High gross margins mean each additional dollar of revenue costs very little to deliver, a hallmark of scalable SaaS businesses. Feeds into unit economics. Gross margin is essential for calculating CAC, payback period, and LTV, two core metrics investors track. Valuation benchmark. Investors prefer businesses with 65% plus gross margin. In SaaS, top performers, especially enterprise tools, can exceed 80%. Predicts profit potential. A high gross margin allows for more spending on growth, sales, R&D, marketing, without sacrificing long-term profitability. Highlights. Operational efficiency. Declining gross margins can reveal rising infrastructure costs, poor vendor management, or inefficient onboarding. All warning signs. Payback period measures how long it takes to recoup your customer acquisition cost, CAC, from the gross profit generated by that customer. In simple terms, how many months until a customer pays back what you spent to acquire them? Why payback period matters to investors. Capital efficiency signal. Shorter payback periods mean startups recover costs quickly and can reinvest revenue into growth sooner, a big plus for investors. Burn rate and runway. Impact, long payback. More upfront cash needed. Higher burn. A tight cash cycle can stress your runway and increase funding pressure. Scalability indicator. If payback period is under 12 months, or ideally 6 to 9, it suggests your growth engine is scalable without massive VC dependency. Benchmark for go-to-market fit. A healthy payback shows that your sales and marketing spend aligns well with revenue generation. A green light for GTM strategy validation. Feeds into LTV-KC ratio. Payback period works alongside LTV-KC, short payback plus high LTV-KC 3.1, strong economics, fundable business. Burn multiple measures. How efficiently a startup is turning cash burn into net new revenue. It tells you, how much money are you burning to generate $1 of new revenue? Why burn multiple matters to investors. Reveals. Capital efficiency, a low burn. Multiple means your startup grows revenue without excessive spending, a sign of great unit economics and GTM fit. Investor benchmark for health. VCs use it to assess whether you're ready for next funding rounds. It's especially useful in tighter funding climates. Performance benchmark. Across stages, early-stage startups may burn more to build infrastructure, but as you scale, efficient growth becomes a non-negotiable. Forecasts, runway, and scaling ability. If you're burning $3 to get $1 of revenue, that's not sustainable without frequent funding. Investors see this as a risk signal. Compares startups. Objectively, burn multiple allows investors to compare startups in different industries, pricing models, or sizes, as it normalizes growth per dollar spent. When calculating CAC, customer acquisition cost, using the formula CAC-SaaS, total sales and marketing costs, new customers acquired, you should include all direct and indirect costs related to acquiring new customers during the period. Here's a breakdown. Include these sales and marketing expenses, paid advertising, Google Ads, Meta, LinkedIn, YouTube, etc., SEO tools and consulting content creation, copywriters, video production, design, marketing software tools, HubSpot, MailChimp, Buffer, event sponsorships and booth costs, webinars and lead gen events. Freelancers or agencies tied to marketing. Branding campaigns aimed at direct acquisition sales expenses, salaries, bonuses, and commissions of SDRs, BDRs, and AEs, sales team benefits and payroll taxes, CRM and sales enablement tools, Salesforce, Outreach, Gong, travel and entertainment costs for prospect meetings, proposal and demo software costs, outsourced sales development firms, overhead, allocated to acquisition, 8% of leadership, CMO, VP sales compensation. If they are involved in acquisition strategy training and onboarding costs for new sales reps, office costs, allocated by headcount if directly tied to sales and marketing teams. Exclude these, not part of CAC. Customer success, onboarding team costs, post-sale, R&D and product development, brand awareness or PR with no direct acquisition goal. Retargeting, upsell campaigns to existing customers. Renewals and account management, long-term brand equity building initiatives. Pro tip: investors often dig into CAC assumptions, so it's smart to calculate. Blended CAC includes all customer types. Segmented CAC, e.g. SMB versus enterprise. CAC by channel, e.g. paid ads versus outbound. Let's cover the ARPU, total revenue cost total customers. Let's bring an example. $10,000 revenue from 100 customers, cost a $100 ARPU. Churn rate. Customers lost. Customers at start. If you lost 10 out of 200 in a month, 5% churn. Let's break down how to calculate customer lifetime value, or LTV, a key metric that tells you how much revenue you can expect from a single customer over their lifetime with your product. Here's the formula. LTV equals ARPU times gross margin, divided by churn rate. Let's walk through a quick example. Your ARPU, that's average revenue per user, is $100 per month. Your gross margin is 80%, meaning after costs, you keep $80 out of every 100, and your monthly churn rate is 5%. So 5 out of every 100 customers are leaving each month. Now, plug those numbers in. LTV, $100 x 0.8, 0.05, $1,600. That means, on average, each customer brings in $1,600 in gross profit before they churn. This is exactly the kind of number investors love, because it helps them understand your long-term revenue potential and pricing power. Now let's talk about the LTV to CAC ratio, one of the most important numbers investors look at when evaluating your startup. Here's the formula. LTV divided by CAC, or in other words, how much value you get from a customer compared to what it costs to acquire them. Let's break it down with an example. Your LTV, or lifetime value, is $1,600, your CAC, or customer acquisition cost, is $400. Now do the math. $1,600 divided by $400, or $4. That gives you an LTV to CAC ratio of 4-to-1, meaning for every dollar you spend to get a customer, you're making 4 back in gross profit. That's solid. A healthy ratio is above 3-to-1, so if you're hitting 4.1 or more, you're in a great place. If the ratio is lower than 3.1, it could mean your costs are too high or your customers aren't sticking around long enough. Something to investigate. Let's move on to another key metric, the CAC payback period, or how long it takes to earn back what you spent to acquire a customer. Here's the formula. CAC divided by ARPU times gross margin. Let's plug in the numbers we've been using. Your CAC is $400, your ARPU is $100 per month, and your gross margin is 80%. So now the math looks like this. $400 divided by 100 x 0.8. That equals $400, $80 AR 5 months. This means you recover your acquisition cost in 5 months, and from month 6 onward, that customer is pure profit. Ideally, you want your payback period to be under 12 months, because the shorter the payback, the faster you can reinvest in growth. If you're in the launch stage, that's pre-seed to seed, you're probably still figuring things out. Your CAC, ARPU, and LTV might fluctuate like crazy, depending on what channel or segment you're testing. Here's what to expect. Churn rate? Between 5% and 10% monthly. Yep, it's high, but normal at this stage. Gross margin. Aim for 70-80%. If it's below 60%, something's off. LTV to CAC ratio? Probably between 1 and 2-to-1. Not ideal, but you're not here to be perfect. You're here to learn and iterate. Payback period? It might take you 12 to 24 months to recoup CACs. That's long, and investors know it. Your job is to improve this with every experiment. Now, if you're in growth mode, Series A or B, the pressure is on to perform. You'll want to hit churn below 3% monthly, or ideally under 15% annually. Gross margin? Boost it up to 75-85%. LTV to CAC ratio? Now you better be in the 3 to 5-to-1 zone. That shows efficiency. Payback period? Investors want their money back in 6 to 12 months. That's the gold standard. Bottom line? These aren't just numbers. They're signals. They show how efficiently your engine is running. And if you're talking to investors, this slide can either open doors or shut them fast. All right, founders, let's talk numbers. How do you actually prove your AI agent is investable? Let's run the math. Real quick, real clear. Imagine you're selling an AI sales agent for B2B SaaS teams. Your price is $250 a month. Now your CAC, customer acquisition cost, is around $600, combining LinkedIn ads and outbound sales development. Your gross margin, after hosting and LLM API costs, is a strong 85%. And you've got 4% churn per month, pretty standard for early stage SaaS. Now, let's calculate what matters to investors. First, ARPU, sure, $250 LTV, $250 x 0.85, 0.04, 5,312. That means one customer brings in over $5,000 in lifetime value. Not bad. Now, the LTV to CAC ratio, 5,312, $600, 8.8 to 1. That's beyond the healthy 3.1 ratio VCs love to see. And finally, your payback period, how long it takes to earn back your CAC, $600, $250, sheet 8.5. Sheeger just 2.8 months. That's lean, efficient, and scalable. If you're raising capital or refining your pitch, this is what investors want to see. Unit economics that scream efficiency and profitability. Want more examples like this? Hit subscribe and check out the full episode. We break it down step by step. I'm Leah, and this is Go.Lofty Academy, where we turn startup math into strategic clarity. Let's wrap it up. Know your CAC, ARPU, LTV, and churn. Hit that golden LTV CAC. 3.1. Track your payback period religiously. Investors want efficiency and predictable growth. If you found this valuable, like the video, subscribe, and check out our playlist on financial modeling and fundraising. And if you want help building a strategy-aligned financial model or investor-ready deck, Go.Lofty has tools, templates, and experts to guide you. Stay smart, stay lean, and keep building. Empowering future leaders with venture building and strategy execution tools. Made by Go.Lofty team.